Wouldn't it be nice if you had a metric that could track the time between when a business pays its suppliers and when the business receives payment from its customers? The cash conversion cycle, also known as the cash-to-cash cycle time, does just that. In this lecture, you will learn the foundational elements of the cash-to-cash cycle time. Let's get started. Cash-to-cash cycle time looks at the amount of time, usually days, of working capital a business has tied up in managing its inventory or supply chain. Like many metrics, the more efficient the cash-to-cash cycle time is, the fewer days an organization's cash is unavailable for use. A cash-to-cash cycle time of 1 month or less would be considered a good time. On the other hand, a cash-to-cash cycle time of 2 to 3 months would show that an organization's cash is tied up and not available for use for what many industries consider to be a dangerous amount of time. Please note that the cash-to-cash cycle time can vary quite a bit between industries. With this in mind, it should be every organization's objective to reduce their cash-to-cash cycle time. How do you do this? One of the primary ways that a company can reduce the amount of time that cash is tied up is to optimize the inventory they have on hand. If cash is not tied up in inventory, it is available for use. This is why continuous improvement strategies like Lean are a very effective way to improve cash-to-cash cycle time. Be aware that improving your overall inventory strategy will require alignment of all parties, including supply chain partners, as well as finding and removing waste and creating a more streamlined organization. Improving order-to-cash processes will also reduce your cash-to-cash cycle time. As invoice processing and receipt of customer payments improves, the amount of time that an organization's capital is tied up will improve as well. 3 possible areas a company can look to improve their cash-to-cash cycle time are: first, invoicing processes can be mapped out and waste can be eliminated to create a more streamlined process flow. Second, many organizations can also reduce or eliminate wasteful activities that do not transform information or materials in any way. And finally, organizations may also analyze antiquated systems and processes and choose to revise inefficient processes that increase the likelihood of billing errors and causing information or material defects. You may be wondering, how do you calculate this cash conversion cycle? The cash conversion cycle is calculated by adding days inventory outstanding and days sales outstanding, and then subtracting days payable outstanding. Let's look at an example. It takes K&K Manufacturing an average of 60 days to sell its inventory. Once they have sold their product, it then takes them about 30 days to collect payment from customers. In general, K&K pays its suppliers in 75 days. With this data, we can calculate our cash-to-cash cycle time. First, we add 60 days inventory outstanding and 30 days sales outstanding. Then we subtract 75 days payables outstanding, and we get a cash-to-cash cycle time of 15 days. Now, you may be wondering, how do I calculate days inventory outstanding, days sales outstanding, and days payable outstanding? Well, in the next few lectures, we will share with you about these 3 elements of the cash-to-cash cycle time. Now, before we go, let's challenge our minds by answering the following question. Let's say K&K Manufacturing takes an average of 32 days to sell its inventory. Once they have sold their product, it then takes them about 90 days to collect payment from customers, and in general, K&K pays its suppliers in about 60 days. What is K&K's cash-to-cash cycle time, and what observations can you make from this metric? Thanks again for watching, everyone, and we look forward to seeing you right back here on Lean Strategies International LLC, where you can find solutions that ignite your power. Days Inventory Outstanding, or DIO as it is often referred to, is a ratio that measures the average number of days that a company holds inventory before they transform that inventory into sales. The lower the figure, the better. You may be wondering, why? Well, lower DIO tells us that this inventory will tie up our cash for less time and that our risk of obsolete inventory is much less, and that is good. Days Inventory Outstanding is also known as Days Sales of Inventory and Days in Inventory. Days Inventory Outstanding is one component of the cash conversion cycle, or cash-to-cash cycle time, which you can learn more about by clicking on a link in the description. The cash conversion cycle is calculated using three metrics. They are Days Inventory Outstanding, Days Payable Outstanding, and Days Sales Outstanding. Why is this important? Well, it tells us that the cash-to-cash cycle time can be improved by reducing DIO, reducing DSO, or increasing DPO. So, how do we calculate Days Inventory Outstanding? Days Inventory Outstanding is usually calculated as shown in the picture here. DIO equals average inventory divided by cost of goods sold times the number of days in the period you are calculating. For example, if a company has $30,000 in inventory on average during a 1-year period, and their cost of goods sold is $143,000, we would calculate DIO by first dividing the average inventory of $30,000 by the cost of goods sold of $143,000, and then multiplying that by the number of days in the period. For example, if our period was a year, we would multiply our answer by 365 days. This would equal a DIO of 76.57 days. Let's now answer the question, what does a high or low Days Inventory Outstanding mean? When a company has a low DIO, it typically means they are converting inventory into sales rapidly. This is a good thing. Another way to interpret low DIO is that there is less chance that inventory will become obsolete. So what does a high DIO signal? In general, a lower DIO is better than a higher one. High DIO generally indicates that a company is not converting inventory into sales fast enough. This could also reveal inventory management issues such as overstocking. If DIO is high, the company's cash is also tied up in inventory for a longer period of time, which also means that the company cannot use its money for other purposes. So, how do you improve your high DIO? There are two basic ways that a company can improve Days Inventory Outstanding. The first is to speed up the conversion of inventory into sales, and the second is to reduce the amount of inventory that you are holding. This may involve using techniques like the just-in-time system or implementing continuous improvement strategies like Lean, which generally have a positive effect on inventory management. In addition to these strategies, many organizations will be deployed honed in on sales techniques like various marketing strategies and using different methods that influence customer sales. And that's it. Days inventory outstanding. Well, thanks for watching, friends, and remember to keep coming back and studying your videos where you can find solutions that ignite your power today. Days payable outstanding is a financial ratio used in accounting and finance departments that measures how many days, usually on average, it takes a company to provide payment to its suppliers. The higher a company's DPO, the longer it takes to pay its bills. Days payable outstanding is calculated using the formula shown here. To calculate DPO, you would multiply accounts payable by the number of days in your period and then divide your answer by the cost of goods sold. Let's look at an example. Let's say K&K Manufacturing has an average accounts payable of $200,000 over a 365-day period, and their cost of sales is $750,000. To calculate the DPO, we would first multiply $200,000 by the number of days in our period, which is 365. We would then divide our answer by our cost of sales, which was $750,000, and that would give us a DPO of 97.33 days. It should be noted that days payable outstanding is the opposite of days sales outstanding and is also a component of the cash-to-cash cycle time. Why is this important? It tells us that companies can optimize or reduce their cash-to-cash cycle time by increasing DPO or by reducing DSO or DIO. So, what does it mean when a company's DPO is high or low? A high DPO means the company is taking a longer time to pay its suppliers. Of course, if a company takes longer to pay its suppliers, they are better able to invest cash for a longer period of time. However, this may not be beneficial for a buyer-supplier relationship. For example, a company with a high DPO may be missing out on early payment discounts offered by their suppliers. It's important to remember that DPO can vary quite a bit between industries and practices. As such, there is no standard number that represents a good or bad DPO. Sometimes, when a company's DPO is low, it could be an indication that the company is not getting the best credit terms from suppliers or is not taking full advantage of the credit terms that may be available to them. With that being said, this could be an opportunity to extend DPO and improve the company's cash-to-cash cycle time. A low DPO, on the other hand, is not necessarily bad, as it may indicate that the company is paying suppliers early and taking advantage of early payment discounts. And that's it. Days payable outstanding. Well, thanks for watching this video on days payable outstanding, and we look forward to having you back here for more great content right here on Lean Strategies International LLC, where you can find solutions that ignite your power. Days Sales Outstanding, or DSO as it is often called, is a ratio that measures the average number of days a company takes to collect its accounts receivable. When a company's DSO is short, it tells us that the company is faster at collecting payments from customers. This also means you are able to use the cash from sales sooner. When combined with days payable outstanding and days inventory outstanding, DSO is a component of the cash conversion cycle. So, how do we calculate DSO? DSO is calculated with the formula shown here. DSO equals accounts receivable multiplied by the number of days in the period divided by the total credit sales. For example, if a company has credit sales of $1.5 million over the course of a year and an accounts receivable balance of $150,000, we would calculate the DSO by first multiplying our accounts receivable of $150,000 by the number of days in our period, which in this case is 1 year or 365 days. Next, we divide this answer by the total sales due to be paid on a future date, which are known as credit sales. In our case, we divide $54,750,000 by $1,500,000. This would give us a DSO of 36.5 days. So, what exactly does 36.5 days tell us? To start, you should know that a high DSO can be dangerous. It indicates a company is selling lots of products on credit and is taking longer than normal time to collect payments for the sales from customers. This will eventually result in cash flow difficulties. On the other hand, a low DSO tells us that the company is collecting payment from its customers quite rapidly. And, as we all know, getting paid quickly is important. Be aware that DSO can vary quite a bit in different industries. With this in mind, we should consider the question, how can we improve DSO? DSO is unique in the sense that you have so much information that can be improved. With that said, mapping your receivable or collection process out and removing waste can improve both the information side of the value stream and the material side of the value stream. Another way to improve your DSO is by automating parts of the collection process. For example, electronic invoicing is much quicker than mailing and faxing. Also, many systems will now automatically guide quotes to POs and POs right into invoices. This makes the information side of the process much more efficient. Another very common way that companies can improve DSO is by giving your customers incentives to pay early. For example, a 210 net 30 means that the buyer receives a 2% discount if they pay the invoice within 10 days instead of within 30 days. And that's it. Days sales outstanding. Well, thank you for watching this video on days sales outstanding, and we look forward to having you back for more great content right here on Lean Strategies International LLC, where you can find solutions that ignite your power.